If you're 60 years old with $1.5 million in your 401k, here's the reality. You were in business with your favorite uncle, Uncle Sam, a minority shareholder with the majority vote. But here's what most people don't realize. You're sitting in the most important tax planning window of your entire life right now. And if you understand how to use this 5-year window strategically, you can legally cut that lifetime tax bill by hundreds of thousands of dollars, maybe even 6 figures in federal tax savings. Hi, I'm Megan Ramshaw, CFP and lead advisor at MOKAN Wealth. At MOKAN Wealth, our mission is simple. Help self-made 401k and IRA millionaires keep more and pay less without jargon and generic advice. In today's video, I'm going to walk you through the exact system we use to turn a heavily taxed $1.5 million 401k into tax-efficient retirement income that lets you keep more of what you've worked so hard to build. Let's talk about where you are at right now. You're 60 years old with $1.5 million in your 401k. Maybe you've stopped working or you've significantly reduced your income. This is actually the best thing that could have happened for your tax situation. Why? Because your taxable income has dropped, which means you're likely sitting in a lower tax bracket than you've been in for decades. For 2025, if you're married filing jointly, the 12% tax bracket extends all the way up to $96,950 of taxable income. And the 22% bracket goes to $206,700. The 24% bracket, which is often the sweet spot for conversions, extends to $394,600. Here's the thing. Once you hit age 73, Uncle Sam is going to force you to start taking required minimum distributions, or RMDs. At age 73, you'll be required to withdraw about 3.8% of your account balance every year, and that percentage increases as you get older. Let's do the math on your $1.5 million. If that account grows even modestly to, let's say, $1.8 million by age 73, your first year RMD will be around $68,000. Add in Social Security, let's assume $45,000 for a married couple, and you're already at $113,000 of income. That's before you've taken a single dollar for your own spending. You're getting pushed into the 22% or 24% federal brackets, plus state taxes, and now up to 85% of your Social Security becomes taxable. This is what we call the RMD tax bomb. But right now, at age 60 to 65, you have what I call your tax capacity, the ability to fill up lower tax brackets intentionally before RMDs and Social Security force you into higher ones. This is your window. Use it or lose it. At MOKAN Wealth, we use something called the 5-seat system, a retirement planning framework designed specifically for self-made 401k and IRA millionaires. The core principle is this: tax diversification matters more than asset diversification. Let me explain what I mean. Most financial advisors, what I call pie chart managers, will show you a diversified portfolio of stocks and bonds. That's fine, but they're ignoring your favorite uncle, Uncle Sam. If all $1.5 million of your money is sitting in pre-tax accounts, every single dollar you pull out is 100% taxable as ordinary income. You have zero tax diversification. Here's how we think about the ideal allocation across what we call the 5 seats, or tax buckets, for someone in your situation. Pre-tax bucket, your 401k, traditional IRAs. This should be your smallest bucket long-term. Why? Because this is the bucket that gets hammered by R&Ds and taxed at the highest ordinary income rates. For someone with $1.5 million today, we typically target getting this down to $600,000 to $900,000 over the next 10 to 15 years through strategic conversions. Your Roth bucket, a Roth IRA or a Roth 401k. This is your tax-free growth engine. Ideally, you want $400,000 to $700,000 here by the time you hit your mid-70s. Every dollar in this bucket grows tax-free and comes out tax-free. No RMDs during your lifetime, no taxation on your widow or heirs. A taxable brokerage bucket. This is your flexibility bucket. You want $200,000 to $400,000 here. Withdrawals are taxed at lower long-term capital gains rates, 0, 15, or 20%. And your heirs get a step up in basis, meaning they inherit it tax-free. An HSA bucket, if you're eligible. If you're not yet on Medicare, max this out. It's a triple tax advantage deductible going in, grows tax-free, and comes out tax-free for qualified medical expenses. Other tax-advantaged buckets. This includes things like cash value life insurance or deferred annuities if they fit your situation, but these are secondary for most people. The key takeaway: you want to break up your $1.5 million so that it's spread across multiple tax treatments. That way in retirement, you can pull from the most tax-efficient bucket each year depending on your situation. Now let's get into the specifics of Roth conversions. A Roth conversion is when you move money from your traditional 401k or IRA into a Roth IRA. You pay income tax on the amount you convert today, but then that money grows tax-free forever and comes out tax-free in retirement. The big question is, how much should you convert each year? This is where most people either do too little, too much, or nothing at all. Here's the framework. Step 1, determine your current taxable income. Let's say you're 62, semi-retired, and your taxable income this year is $60,000. Step 2, identify your target tax bracket. For most people, we target staying within the 22% or 24% federal bracket. For 2025, the top of the 22% bracket for married filing jointly is $206,700. That means you have $206,700 minus $60,000 is $146,700 of room before you hit 24%. Step 3, factor in IRMAA thresholds. Here's where it gets more nuanced. IRMAA, Income-Related Monthly Adjustment Amount, is the surcharge you'll pay on Medicare Part B and Part D premiums once you turn 65. For 2025, IRMAA kicks in at $106,000 of modified adjusted gross income for single filers and $212,000 for married filing jointly. If you go over these thresholds, you'll pay hundreds or even thousands more per year in Medicare premiums. For someone at age 60 to 64, we often target keeping conversions below the first IRMAA threshold to avoid future premium spikes. Step 4, execute the conversion and pay the tax efficiently. Let's say you decide to convert $100,000 this year. That brings your total taxable income to $160,000. Your federal tax on that conversion is 22%, about $22,000. Here's the critical part. Pay that tax from your taxable brokerage account or cash savings, not from the IRA itself. If you withhold taxes from the IRA, you're reducing the amount that gets into the Roth and losing all that future tax-free growth. Step 5, repeat annually during your low income window. From age 60 to 72, before RMDs start at 73, you have roughly 12 years to systematically move money from pre-tax to Roth. If you convert $100,000 to $150,000 per year during this window, you can move $1.2 million to $1.8 million into Roth over that period. That is life-changing. Once you've built tax diversification, the next question is, what order do you pull from these accounts? The sequence matters tremendously. Here's the strategy we use. Ages 60 to 65 before Medicare and Social Security, this is your Roth conversion window. Pull spending money from your taxable brokerage account or cash reserves while you're doing conversions. This keeps your tax bill low and maximizes the amount you can convert. Ages 65 to 72, when Medicare starts but before RMDs, continue Roth conversions, but now you need to be more mindful of IRMAA. Pull spending money strategically, maybe some from your brokerage account, some from Roth for big expenses like travel or a new car, and fill up your lower tax brackets with IRA withdrawals or conversions. The key is to stay under IRMAA thresholds 2 years before they apply, since IRMAA uses a 2-year look back. Ages 73 and beyond, when your RMDs kick in. Now you're required to take money from your traditional IRA, whether you need it or not. Here's where your earlier Roth conversions really pay off. Let's say your RMD at 75 is $80,000. If you still need to pull another $40,000 for spending, pull that from your Roth IRA, completely tax-free. If you have charitable intent, use qualified charitable distributions, also known as QCDs, directly from your IRA to satisfy part of your RMD without increasing your taxable income. The goal is this: keep your taxable income in the 12% or 22% brackets as long as possible. Minimize IRMAA surcharges and pull from the Roth for anything above that. Let's talk about the long-term impact of this strategy. If you execute this plan correctly, here's what happens. Tax-free compounding. That $1.5 million in your 401k might grow to $3 million or more over 20 to 30 years. If a significant portion of that growth happens inside a Roth IRA instead of a traditional IRA, you're talking about potentially $500,000 to $700,000 in tax savings over your lifetime compared to doing nothing. Widow's penalty protection. Here's something most people don't think about. When one spouse dies, the surviving spouse loses one Social Security check, but keeps most of the income. The problem? They now file a single tax filing instead of married filing jointly. The single tax brackets are roughly half the width of the married filing joint brackets. For example, in 2025, the 24% bracket for single filers starts at just $103,350 versus $206,700. That means the surviving spouse can get pushed into much higher tax brackets on the same income. This is called the widow's penalty. But if you've moved a large portion of your retirement savings into Roth accounts, the surviving spouse can pull from these tax-free, avoiding the trap entirely. Estate planning advantages. When you pass away, your heirs inherit your Roth IRA completely tax-free. They'll have to distribute it within 10 years under current law, but every dollar they pull out is tax-free. Compare that to inheriting a traditional IRA, where they'll pay ordinary income tax on every distribution, potentially at their highest earning years when they're in the 32 to 35% brackets. A Roth inheritance is a true legacy gift. Look, turning your $1.5 million 401k into tax-efficient retirement income isn't something you can do on your own with a few Google searches. It requires forward-looking tax planning, strategic Roth conversions, withdrawal sequencing, and coordination with Social Security and Medicare. That's exactly what we do at MOKAN Wealth. We help self-made 401k and IRA millionaires avoid the 7 hidden tax surprises and keep more. You've worked too hard to hand over 30 to 40% of your retirement savings to Uncle Sam. Let's build a plan to keep more of it.